Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with someone who is important to the debate around market efficiency and in advocating for retail investors to have parity with other investors. Mike Green, CFA, is Chief Strategist of Simplify. Previously, he held similar roles for Logica Capital Advisors and Peter Thiel's family office, Thiel Macro. Before that, he founded Ice Farm Capital, a discretionary global macro hedge fund that was seeded by Soros Fund Management. And before that, he was with Canyon Capital Advisors. He is a Wharton grad. So, welcome to the podcast.
Thank you for having me, Rob.
So, I'd like to start with just sort of your career path, which I find very interesting because you have a pretty sterling hedge fund resume, and something pulled you over to Simplify. So, how'd you get there?
Well, so the easiest answer to that is the traditional challenge within the hedge fund space has actually been things like the tax efficiency of strategies that are often pursued within hedge funds, particularly derivative heavy components. As a result, really hedge funds are largely an institutional framework. They typically are pursued by institutions that have tax advantages, whether those are endowments, insurance companies that can conceal components within an internal operation. They're very rarely actually particularly suitable for high net worth individuals or family offices, even though that's kind of the sexy area in which they often get caught in, right? What I recognize is with some very minor changes, or actually fairly major changes in the regulatory framework that occurred in 2019, ETFs experienced what's called the ETF rule, which facilitated the creation of new ETFs. And then in 2020, the derivative rule was passed, which facilitated the inclusion of complex strategies in ETFs that ultimately almost all hedge fund strategies that were directed at high net worth individuals, family offices, et cetera, were going to make that transition over to 40 Act type products. Simplify provided me with a platform that allowed me to very quickly exploit that viewpoint. And, candidly, it seems to be playing out that way. We've gone from basically nothing to about $4 billion in assets under management in a time period in which the industry itself is in aggregate shrinking. That to me has really been a proof of the insight being correct, that we are moving in this direction. We need to accept this. And candidly, I'm just getting phone calls from hedge fund managers and investors who are continually saying, start telling me about this ETF space.
Oh, wow. Okay. So that is, I mean, it was coming a long time. Most of the legislation was coming a long time. So I'm a little surprised more people aren't ready for it. But the, well, let me shift gears a little bit here because in our prep, we had some really interesting conversations about some perennial arguments around things like market efficiency, how people can get focused on one number while others are around, and, that impact that has on asset allocation, passive investments, et cetera. So, you know, that's a very long-winded way of saying, why don't you tell us what's in your paper? So,
Yeah. So I think the easiest way to start on this is this is the giant elephant in the room, right? I like to joke that it's very similar to the David Foster Wallace speech. This is water, right? The medium in which we are operating has changed radically over the course of my career. I entered the industry around 1992. Some might argue I left it sometime around 2016. That's a joke. But the underlying character of the industry has radically changed, and we all feel this. And the real component behind that has not, in my opinion, been the growing activism of the Fed or other regulatory parties. It actually, interestingly enough, has been the growth of passive strategies or systematic allocation strategies that have exploded on the scene, growing from about 1% market share in 1992, which, that was 18 years after the introduction of Vanguard. It was about 1% market share at that point. Today, it appears to be somewhere around 40% of all assets in the US equity markets are now managed in a passive allocation methodology. There is some evidence that that's higher than that. And certainly within some areas of the US equity markets, it's already over 50% that we're starting to see this type of management. A lot of people just add up the share of Vanguard or BlackRock, maybe add State Street into the mix, et cetera. That's a really inappropriate way to actually build it because you're forgetting everything from futures to separately managed accounts that are managed in this way, to commingled investment trusts, CITs, to total return swaps. Like the list just goes on and on and on. And I would just point to people that, when you start seeing things like the CIO of CalSTRS or CalPERS get on and say, well, a long time ago, we abandoned the idea of active management for our beta exposure. they're giving you insights in terms of how far this has penetrated into the market. And when that happens, you have to start saying, how has the change in the medium actually changed the behavior of the environment in which I interact, right? So the water has gotten warmer, is I
Right.
guess the easiest way to put it.
Right, to put it in Wallace terms, yeah. So how has it? So,
Well, so the minute you actually accept that this structural change has occurred underneath, you then have to actually ask yourself, well, what is actually the theory of passive, right? What is the theory behind why this should actually be possible? I fully owe credit to Lasse Peterson at AQR for having written a brilliant paper in 2016 called Sharpening the Arithmetic of Active Management. Lasse's paper, right, which came out similar in time period to the observation from Sanford Bernstein. I think it was Fraser that Inigo Fraser that came out with the report. You know, pass indexing is worse than Marxism, I think actually it was called. Right? So I mean, obviously that's a catchy title, and you know it's a lot of fun. But the Lasse criticism was a little bit different, right? So Fraser Jenkins, Inigo Fraser Jenkins, that's what it is. I was about to say Inigo Fraser Montoya, thinking of The
different,
Princess
right,
Bride, which is
different
my
movie.
avatar on Twitter, so I'm laughing about that. But you know, his observation was, look, there's no process of capital allocation that's going on. That ultimately is, you know, the antithesis of how capital markets are supposed to work. Our objective is to actually be pricing that marginal cost of capital and guiding corporate decisions with our investment dollars, right? That's the theory behind it. The real insight that came in from Lasse Peterson was to go back and read Bill Sharp's 1991 paper, The Arithmetic of Active Management, and challenge the assumptions on it. And I think this is actually really an important thing for people to recognize, is that all of the papers that we were trained on as CFAs, things like The Arithmetic of Active Management, have underlying assumptions that really were not challenged, primarily due to the computational intensity of challenging them at that point in time. So Sharp's paper makes a very simplifying assumption. What is a passive investor? According to Sharp, it's an investor who never transacts. They always hold. Right? Now, Lasse Peterson looked at that and he said, hey, wait a second, what about when indexes rebalance? Right? Then they have to transact, right? And by the way, this is actually one of the largest businesses within hedge funds today, are things like index arbitrage around events like index inclusion. Been incredibly profitable for players like Millennium. I believe Balyasny and others have significant resources that are devoted to these types of strategies. I simply provided the next step, which is to say, hey, wait a second. I think actually Lasse understated the issue here, because under the model of Sharp, any investor who is not passive is active by definition. And Lasse Peterson points out that when indexes rebalance, they cease to be passive. They must become active. Therefore, they're in violation of Sharp's articulation. My observation was simply, wait a second, every time Vanguard receives an inflow or an outflow, they have to transact. And so by definition, they actually can't be passive investors. You either have to believe in magic, right? That they just magically come into the market, or you actually now accept that they're active investors that operate under a particular set of rules. And understanding that set of rules can help us understand the impact that they have on markets. That's really been the focus of the research that I've done around this. And when you actually approach it from that standpoint, you discover that their footprints are everywhere. Far more powerful, in my opinion, than the Federal Reserve, for example.
Right. So how is this translated into, perhaps the misuse or the misunderstanding of and the impact on asset allocation theories and passive investment portfolio management?
Well, that's a huge leap, right? So part of what I'd like to do is actually kind of guide
You
people
want to go back
through
first?
the
Okay.
steps
Yeah.
here.
Okay.
Yeah,
Yeah.
so let's
Okay.
get to the point that we actually
Okay.
demonstrate how it's impacting and changing markets. And then there's some really interesting insights that actually do play through to asset allocation and extend not just from public markets, but I would actually argue all the way into private markets, and highlight many of the challenges that people are now suddenly recognizing about private markets. I actually think not only are those challenges actually somewhat directly tied to the growth of passive investing, but actually a lot of the societal ills that we're seeing in many ways reflect this underlying behavior as well.
Yes. Yes. Good point. So let's go back. So the passive active definition established.
Yep.
So let's go
So
from
once
there.
you actually do that, let me actually just jump over to a presentation that I've shared with you, and we can walk through a couple of these things to help people understand these types of dynamics. So the first thing that I would point out for people, one, I've put this presentation together over the years. It's called The Greatest Story I Ever Sold: The Impact of Passive Investments on Markets. It's the working title of a book, which ultimately I'll put out. But it really is highlighting that this is ultimately a marketing story, right? I did an interview of Bob Pisani about a year ago now, in which he was highlighting the magnificent impact of John Bogle on him by, John Bogle sharing, you just need to be patient, you need to be in the market, you need to do all these things. And his description was, Bogle was behaving like I expected Bogle to be. He was professorial, he was supportive, he was kind, all these sorts of things, right? And I turned to him and I said, okay, so Bob, he sold you, right? And like, it was literally like, you could see that I had, basically attacked him with a cattle prod, right? How dare I speak back against Bogle? But this really was a marketing story, and it's important for people to understand that the growth of these strategies and the promotion of them by Vanguard was because Vanguard could not grow in any other way, right? And all the wonderful narrative about what a great thing it is largely a byproduct of the marketing components to it, right? So with that in the background, let's actually hit on the scale and the growth. Right. So as of 1995, passive share was somewhere in the neighborhood of 2%. It's now grown north of 40%. This is certainly true for the mutual fund and ETF space. And I just want to emphasize that the growth of things like active ETFs, while I consider it to be a modest positive, it's just not even remotely relevant at this point. Last year, passive strategies in aggregate took in something like $600 billion. Less than 10% of that was active ETFs, right? It's significantly less than that. And
Right.
so
Most of it is mutual
really,
funds. Yeah.
right, exactly. And mutual funds are just net outflows at this point, right? So let's like be really, really clear on this. That what is actually happening is we're firing active managers in aggregate. We're hiring passive managers. We also have significant regulatory frameworks in place that are now encouraging that. So in particular, I'd highlight the Pension Protection Act of 2006, which changed the 401k space in a very tangible and important way, moving it from an opt-in model to an opt-out model. You used to have to choose that you would withhold for your 401k. In 2006, that changed. You have to choose not to participate. When you do that from a regulatory framework, you have to decide what you're going to put their money in, because it used to automatically go into a money market fund. By definition, since you had opted in, you were theoretically an involved participant. You would then proceed to make allocations. If it is an opt-out framework, you've made no active articulation of it, and they need to put you into something, right? Initially, that what's called a qualified default investment alternative was balanced funds. In a perverse way, this really drove the growth of entities like PIMCO in the 2006 to 2012 time period, because they specialized in both bond and, to a lesser extent, equity expertise. A balanced fund that was kind of 50-50 bonds and equities was almost perfectly down their wheelhouse. In 2012, that was changed to target date funds.
Target date funds. Yeah. Yeah.
And people forget target date funds didn't exist prior to about 2003, right? They didn't actually exist. I think the Fidelity lifestyle funds were among the first to come into this space. Target date funds, ironically, went from zero in 2003 to today, they're roughly 50% larger than the entire hedge fund industry.
Right. Just based on apathy.
Just based on, well, yeah, and it is beyond apathy now, right? Because the actual statistics are pretty incredible. In this opt-in QDIA type framework, something like 95 cents on every incremental retirement dollar is now going into target date funds. Of those who go into target date funds, 85% of them never transact. They just never change their allocations. They keep their allocations, right? So this is the ultimate, beneficial neglect type dynamic.
Right. A great business. Right.
What an amazing
client that will never fire you.
Right. And by the way, this is actually further than supported. So the DOL fiduciary rule, which fortunately we stopped in 2017, was heading us down a path where it would have been actually embedded in the legal framework that the only thing you could legally do was offer the equivalent of a target date fund, low cost index funds, et cetera, right? Fortunately, we escaped that, but the underlying belief system that ultimately everybody should be investing passively has continued to persist, and the scale of the problem has become so large now that it's having a very material impact on market behavior. Okay, so if we actually then go one step further and we say, how big is this? I can't blow it up, but you notice in the bottom corner there's a piece by Alex Chinko and Marco Salmon, one's a PhD candidate, the other's a professor at Harvard Business School. They actually went in and they looked at the ownership of passive, and this was actually in response to a challenge that I made to Marco that his data was simply wrong in terms of the passive share. They chose to respond to it in the best way that all CFAs should, which is prove, right? And they came out and found out that I was right, that it actually turns out that the passive share is at least double what people thought, right? So that tip of the iceberg was a really small problem. John Bogle himself actually said, look, if everybody's passive, the only words you could use is chaos, catastrophe, the markets would fail, right? And that was said back in May of 2017. And for those who have forgotten, like Bogle had a little bit of a love-hate relationship with what Vanguard ultimately became, until he realized that his hagiography was going to be much better served by embracing all of this and saying, oh, this is the most wonderful thing. It's the best interest for investors, et cetera. But he still offered some criticisms. And many people will remember him saying, like, the markets, though, could get to like 85 or 90% passive before this becomes a critical issue, right? Now, the problem is that that analysis was static in its model, right? So the research that I've seen that's linked to those statements runs scenarios in which you look at how the market behaves when it's 10% passive or 20% passive or 30% or 70%, et cetera. It doesn't consider the transition process, right? And so a market that is going from 30% passive to 40% passive actually has a really unique characteristic to it. More than 100% of the flows that are actually going into the market are passive.
Right, would have to go to passive to reach that.
Correct.
Yeah, yeah.
Right. So to make that transition, what that means is this dynamic happens far, far, far earlier. Right. My math suggests somewhere around 50% passive in aggregate. You cease being able to make quote unquote rational predictions around how markets behave because you now effectively have an irrational actor, somebody who will pay any price for a company.
Right, just to get to that level. Yeah. Yep.
Right. And so, that's contra to the underlying thesis. Now, in support of that, you can actually see the flows. The active managers are getting fired. The passive managers continue to attract inflows. JP Morgan ran an analysis back in 2017, and this has only gotten worse, that less than 10% of the fundamental activity, but less than 10% of trading activity now involves a fundamental insight in any way, shape, or form. In other words, the lunatics have been in charge of the asylum for a very long period of time, but it's just getting worse.
So 90% of so that means 90% of the trading activity was just to meet the requirements of the passive investment, whatever it was, the index or whatever.
It could be everything ranging from hedging total return swaps to option-related activity to indexing itself, right? We see this in the large quantity of shares that are being traded at end of day and VWAP programs, et cetera. Very few of those have any sort of fundamental component to it, right?
Right. It's a policy.
Right. And so like the unfortunate reality is that these two things interact. It matters both the level of transaction activity and the share, because as the passive share grows, it effectively becomes more and more like a market that is composed of low float stocks. So that quantity of trading that is actually occurring becomes more and more focused around the arbitrage and the fulfilling of indexing as compared to the incorporation of fundamental insights. When those fundamental insights momentarily dominate around things like an earnings report, very unpredictable action can happen. We've seen this in the past couple of years, right? Where, super mega cap companies will see their market capitalization change in an extraordinary fashion. When I think about that dynamic, this is going back to the Bill Sharpe paper, right? He's highlighting that an active investor is one who is not passive. There's no mechanism for passive investors to actually transact. Okay. Ironically, this is a slide that I have left unchanged since 2018, right? How should passive investing impact markets? And it was really built around this theoretical framework of what should we be looking for if we were actually seeing the impact of passive investing in markets. You would expect to see an increase in correlation between securities, not necessarily priced and implied correlation. I just want to be clear, right? But realized correlation levels. The second is an increase in valuation of securities, regardless of fundamentals, as the passive share grows. for two reasons. One is passive reinforces momentum. It allocates more capital to things that rise in price, less capital to things that fall in price. It turns out that that's actually the opposite of much of what we see as fundamental behavior, which has characterized markets historically. And I will go into that in its importance. Reduced market elasticity raises the risk of extraordinary price movements. We just this for a second, but like this is really straightforward. Vanguard has to buy Apple shares. They have to buy Nvidia shares. They don't care what happens to the earnings. Discretionary managers may choose to, may choose not to. Ultimately, the big passive players have to buy the largest market cap companies. And ironically, that creates conditions in which it behaves very much like low float. Obviously, that in turn leads to an increase in market concentration as that momentum bias leads to the largest companies becoming larger. And finally, I think this is actually a really important one that I think people have underappreciated. The rise of passive ultimately reduces the ability to get new companies public, right? And this is a really important component. And I think actually digging into that into some detail, particularly for a CFA-oriented crowd, is going to provide some really interesting insights.
Yeah, well, when I was reading your presentation, there's an exceptionally interesting correlation between this and the growth of the private markets.
Absolutely. I think that's
Yeah,
absolutely correct.
and this is something that's been a very hot topic here. But please go on.
So one is this issue of correlation, right? And correlation, you have to remember, has multiple components to it. One, candidly, is really hard to calculate, right? In order to properly calculate correlation, you need to do a 500 by 500 covariance matrix. You need to have the instantaneous weights of all the individual components of the S&P. You need to incorporate the magnitudes. It's very hard to calculate.
It's a lot of data. Yeah, for
A
sure.
lot of data, right? And so most correlation series will stop sometime around 2005 at the latest. Most of them will actually don't start until somewhere around 2012, because that's when the data sets became relevant as people began to actively trade things like volatility futures, right? Okay, so it actually turns out that you also need to make an additional adjustment. You need to adjust for realized levels of volatility. So if you have very low volatility, almost by definition, you're going to have low correlation, because about half the companies are going to be up and about half the companies are going to be down, and you're going to experience low correlation. So you actually need to run your correlation analysis on a volatility adjusted basis. And when you do that, you can actually create this chart, which looks at something a little bit differently. This is called binomial correlation, taking advantage of a mathematical concept called Kendall's tau. And you can think about it almost like the Rockettes, right? So you see the Rockettes up on stage. They're obviously not all the same height. They obviously have the same leg length. Obviously, we want them to have longer legs, but they can't all lift their legs the exact same height, etc. By moving in concert, they create the illusion that they're effectively identical, right? The binomial correlation dispenses with the magnitude and weighting and simply asks a really simple question. Did they move in the same direction on the same day, right? And when you actually do that and you then further adjust for the realized levels of volatility, saying when the market moves 0 to 25 basis points, how many stocks moved in the same direction? When it moves 25 to 50, how many stocks moved in the same direction? When it moves 50 to 100, et cetera. And if you hold those observed levels of volatility constant, this is the chart that comes out, which is telling you all the way back to 1928, we're now experiencing levels of correlation that are totally unprecedented in their construction.
Right. So it's because this is a audio podcast, I just want to describe the chart real quick. So basically, this is a flat line from 28 to 92. At which point,
let's just be clear.
yeah, sorry, 1928 to 1992. Then hockey sticks from there, rises at what is that? Probably 7% per year.
Something like that, yeah.
Yeah. So,
the easiest way to point to it is just to say today, we've roughly doubled the correlation of the market on a constant volatility basis, right? Now, all else equal, that should lead to much higher levels of implied volatility, et cetera. And ironically, we aren't seeing it. It also has a very fundamental component to it. And I've got a couple of things that are noted on this chart, right? In 1940, the Investment Company Act did something that most people don't really think about. It restricted the use of leverage to disclosed leverage. This is a direct byproduct of the unit investment trusts in the 1920s and 1930s, not having to disclose the quantity of leverage that they were using. As a result, in order to juice returns, leverage was used liberally. That in turn creates coordinated events when the market falls, similar to what we see in crypto, right? The liquidation type dynamics, right? These liquidation waves that occur raised the correlation in the 1930s. When we stripped that from the system, we moved to a much lower correlation regime until we unintentionally reintroduced it under lobbying from the index providers in 1994.
Right.
Right.
Which
So
is, yeah, right where this thing hockey sticks. Yeah.
right, it's
Yeah.
exactly where it turns,
Yeah.
right? And on February 5th, 2018, Volmageddon, right? Something happened that crazily enough has never happened before, right? Every single stock in the S&P went the same direction. 1987, when the S&P fell by an ungodly amount more than it did on Volmageddon, didn't see every stock go in the same direction. There was still a fundamental component, even though the market had been largely dominated by the futures in the portfolio insurance type framework, right? On February 5th, 2018, every stock went in the same direction for the very first time in history. It then happened twice in the fourth quarter of 2018. It then happened 3 times in March of 2020. Right. And so we're seeing a rise in this underlying dynamic. And actually today, even as the market is pricing in extraordinarily low levels of correlation, almost unprecedented levels of correlation, like binomial correlation metrics are actually showing up as saying, no, they're still very elevated. Right. And so what's really happening is the narrowing of the market, exact same phenomenon. I showed you another chart. I'm not going to put it up in this because, again, it's a podcast, and so nobody would actually get it. But we're seeing this breakdown in correlation between equal weighted indices and cap weighted indices, exactly as we saw in the 99 type framework, right? Part of what people don't realize about this is what actually happened in 99 was what I would call indexing 1.0. And this was because what was actually occurring in 1999 was the indices were improperly constructed. They used to be built on the basis of market capitalization. Most people think they still are. They're not. They're float adjusted market capitalization. And the unique feature in the mid 1990s was that you had high market cap, low float companies like Microsoft, Cisco, Dell, right? It had a high overlap with the technology sector. We didn't have factor funds back then, sector funds, right? The Fidelity Technology Fund or the Putnam Technology Fund, right? The overlap that those had with this low float characteristic is really what powered that market dynamic. And candidly, I think Standard & Poor's and Vanguard and others were very disingenuous in their presentation of the impact of that when we changed to float adjusted in 2003, 2004. They focused on this idea that it wouldn't have had any meaningful impact because it didn't change the weightings very much. But it completely failed to
6
consider
years later. Yeah.
the factor itself, right? This low float dynamic, that actually turns out to have been quite large. Okay, so that kind of brings us to, we're experiencing these very high levels of correlation. The second statement I made is this rising valuation component. That actually has 2 dynamics to it. And I was really surprised. This is, again, proprietary research that I did. I don't write these things up for SSRN. I'm not an academic. I'm not trying to make it into the Financial Analyst Journal, although I probably should at some point do some of this.
I was gonna say you might.
I should. I know the answer is I should, right? But so I actually went out and I did a survey of investors. I reached out to about 450 investors. One of the wonderful things about social media and becoming well known on social media is people actually respond to these things, right? So I have resources that are available to me to do this type of research that many others might not have. But I went out and I asked a really simple question. You're a portfolio manager. You have 5% cash in your portfolio, so cash is not a constraint really in either direction. You receive a 1% new inflow or outflow. What's your propensity to buy or sell given valuations? And so the chart that you're looking at that unfortunately our listeners can't hear is effectively a marginal propensity chart, right? The marginal propensity to buy, marginal propensity to sell for active managers given valuations. Unsurprisingly, the marginal propensity to sell rises as valuations rise.
As valuations rise. Yeah, makes sense, right?
Right, makes perfect sense. Unsurprisingly, the marginal propensity to buy rises as valuations fall. That shouldn't surprise anyone. But what is remarkable is the intersection of those 2 curves, right? Remember, this was a survey I did. I did not try to solve for this. The intersection of those 2 curves hits almost exactly 50-50 at exactly the market's historical valuation average. And when you run this through an agent-based model where I give individual agents these types of behaviors, right? So they're willing to sell as valuations rise, more willing to buy as valuations fall, you actually discover why the Shiller PE worked. It's because individual discretionary managers are discounting. They're less willing to buy as valuations rise, more willing to sell. And so that actually creates a mean reverting market construction,
Right, right.
right?
And
So
it's what the people can't see is these lines are pretty steep. So the propensity to buy and sell changes exceptionally quickly after
correct,
16x, right? So
correct.
that would be give you the idea that the change in the market would happen pretty quickly too.
Absolutely correct. And that's exactly, by the way, the second chart that's on this page shows the evolution of an agent-based model. This is the central tendency of the model. When you run this type of simulation, it shows nearly perfect mean reversion. And this is exactly what we've seen with the Shiller PE, right? This is why Robert Shiller won the Nobel Prize, because he basically showed us the empirical evidence of mean reversion in markets. That's what the Shiller PE is all about, but he provided no mechanism for it. And this actually is the mechanism by which it plays through, right? So if the Nobel Prize Committee is listening, I'm joking.
Oh, they are. They listen to this podcast.
Okay, so now what happens next? Now I introduce a player called passive that has no reference point to valuation whatsoever, right? The rules of passive, turns out, are simply, did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. There is no reference to valuation. And so when you introduce that player into the market and you allow it to gain share, what it causes is the market to become imbalanced in that historical 50-50 mean reverting framework in which people buy or sell based on valuation. You've now actually moved to a model in which the growth of passive is creating a mindless Borg that simply says, thank you for the cash, therefore I'm going to buy. And when you run that same simulation with passive share gain, it shows up as accelerating valuations.
Right. So technically the marginal propensity rises.
Exactly correct. The marginal propensity to both buy and sell rises. The problem is, of course, that because it's all inflows into passive, that marginal propensity to sell almost never plays through, right? But when it does, and I can actually point out, I'm not going to include it in this presentation, but every time period in which I see redemption from passive, it's the market crashes. Things like August 2015, where we're told a story about, well, it's because China devalued their currency, right? That's just nonsense. That's not what happened. The Chinese deval happened on August 12th. The crash happened on August 25th. And what happened on August 25th, 2015? Vanguard rebalanced their target date funds,
Okay.
right? Now, unfortunately, that empirical data or that theoretical model I just showed you almost perfectly matches the empirical data that we're experiencing, right? Now, I think it's a little bit of a coincidence that the very first index fund that came into the market is exactly where valuations historically bottomed. But I don't actually think that's causative, but I do think it's important for people to understand that they are kind of closely linked. And if I look at the 90s, the late 90s behavior, in my view, this is absolutely what has now become the dominant feature in the market.
Right. I mean, it's important to understand that, or for people in the podcast to understand that causation is usually not one thing. It's slow growth and Brexit, if you will. So,
Absolutely
yeah.
right. And by the way, like, until this, I mean, this is one of the wonderful things about living in a world that is non-static, right? Until this past few years, we could actually believe the articulation that, well, the reason why valuations are high and rising is because the central banks have cut interest rates to very low levels, right? So we could at least kind of argue that the cost of capital had fallen and therefore equity prices should be really high. Well, we've now actually had the empirical observation of raising interest rates in a nearly unprecedented way, and it's had almost no material impact on
Yeah,
valuations whatsoever,
exactly. Yeah, which
right?
makes people real nervous. Yeah. So,
Well, it
yeah.
should make them nervous because it tells you that the models we have around how this works are wrong, right? Now, there are other mechanisms that are in play here, obviously. One of which is the propensity to hold cash. So I introduced this with the idea of, the analysis with the idea of you're an investor, you have 5% cash, that's not a problem, right? But there is actually another perverse angle to this, which is when you introduce passive vehicles, they don't hold any cash. And so you basically have to think of cash as toxic in that environment, right? I have to get rid of it. I have to get rid of it, right? Otherwise, I'm violating my fiduciary responsibility as a passive manager. Now, a lot of people would think that that has a relatively minor impact. Most people would say, well, if you move from 5% cash to basically 1% cash or 0% cash, right? And I think the market is about 1% right now. That shouldn't have that much impact. Markets should go up by 5%, right?
Unless we're 50% of the market.
Well, so this is where the problem is, right?
Yeah.
It's not actually, that's not a solution set that exists. And perversely, it actually turns into an exponential series in terms of its impact. You can think about this. This is actually why Bogle sees 90% is where markets start to break down. At 90% passive, there's simply not enough cash in the active manager community to facilitate the trading activity from the passive managers in those simulations.
Right, just that alone. Forget about any other transaction,
Forget
just
about
that.
any of the other stuff we're talking about. So that's where his breakdown is occurring. That's why he gets to that point. My point is all of that happens far faster if you actually treat it as a dynamic model. And so I think we're unfortunately getting very close to the point that these things become uncontrollable features in markets, right? The other thing that's really important is to understand that the academic literature is changing rapidly, really, really rapidly. So I highlighted Lasse Peterson in 2016. That work changed the way that I think about markets, but it pales in overall importance relative to the work that's been introduced in the 2020s, things like Gabay and Koijin's In Search of the Origins of Financial Fluctuations, the inelastic market hypothesis, which challenges some of the underlying assumptions of how efficient markets are supposed to behave, right? So this is again, it's a CFA audience, so we're going to get super geeky, right? Even in the CFA community, I'm about as nerdy and geeky as they get.
Yeah. I think we're there.
Yeah, exactly. So it's fun though. It freaks people out because they expect me to be about 5'6" and
Right.
Coke bottle glasses, and I'm a 6'4", look like a football player, right?
Yeah.
But the data that is actually coming out now is really important to understand that it violates, right? The analysis is coming out, it all violates things that underpin the assumption of how efficient markets are supposed to work. Importantly, the efficient market hypothesis assumes that markets are highly elastic, that they can accommodate inflows of capital with very little change. In other words, each individual participant is contributing a little bit to the dialogue, not an overwhelming shout, right? In particular, the efficient market hypothesis around elasticity presumes that the elasticity of the market is such that $1 in basically creates about 1 penny of market capitalization, right? And that makes sense when you think about it just from a purely simplistic standpoint. Every buyer has a seller. Therefore, you haven't really meaningfully changed market construction. It should have a very small impact. The work of Gabay and Koijin actually suggests that that's totally wrong. $1 in actually creates, and again, this is computational capability that allows us to now do this work that couldn't have been done in 1990. Their analysis suggests that it's somewhere around $5 of market cap that's created. So $1 in creates $5, not a penny, right? In other words, we're misspecified 500 to 1. Right? Like, I'm sorry, that's not even good enough for government work, right? Like, let's just be really, really clear. As a private sector, we have let ourselves down, right? Okay, it gets worse than that though, because I can hear in the audience people screaming, but Grossman-Stiglitz, right? The incentive to do this stuff, right? Okay. So the problem with Grossman-Stiglitz is it also has assumptions in it. Grossman-Stiglitz is simply another way of saying the wisdom of crowds. Right? If everybody is placing a vote and that vote is horribly misinformed, there's an incentive for an individual to go out and do research and get a better guess, right? So the wisdom of crowds is often framed in the context of the jelly bean jar, right?
Mm-hmm. Yep.
Okay. So the jelly bean jar works where everybody gets to go to the fair and everybody gets to put down an individual vote, right? And you get to say how many jelly beans. And there's super nerds like you and I who are going to measure the size of the jar, and we're going to figure out the individual size of a jelly bean. We're going to try to calculate. We're going to come pretty close, but the odds of us individually having captured every factor and correctly calculated it are very slim, right? We can't possibly know the spacing between each jelly bean, et cetera. As a result, because everybody gets a vote, you get something that looks like a normal distribution. There's people like you and I are close to the center, and then there's crazy people like, I think there's a million jelly beans in there. People like, I don't see a single jelly bean, right? And so you get these random outputs that largely creates a normal distribution around the right answer. This is the wisdom of crowds framework, right? You know how I break that? I create a single individual and I give them 1,000 votes. Suddenly it's no longer reflecting the wisdom of the crowds. It's actually reflecting the wisdom of one individual, right? And that's really where we've moved to. We've moved to an environment in which the voice of passive is now the dominant voice, right? Grossman Stiglitz presumes that the endowment, the assumption is the endowment of each player is the same. In other words, the capital that any one individual brings is identical. That wasn't a really terrible analysis back in, it's a model, right? So it's a useful but not accurate representation of what the world looked like in 1980, when the thundering herd of Merrill Lynch was the dominant feature, but each broker could direct their clients into whatever they thought was appropriate, right? So each individual had a tiny voice. Today, we've moved to a world that doesn't look anything like that. The only voice that really matters is the voice of market cap. The second thing that happens is you start taking away cash. And so I'm highlighting here the comparison between the world's largest active equity fund, which remains Fidelity Contra Fund. It's about $1 billion or $100 billion in total assets. It carries about $2.5 billion worth of cash. And by the way, it's getting redeemed every single day. But that 2.5% cash, or slightly more than 2.5% cash, I think is pretty indicative of where the overall active space is. And ironically, that level of cash has been forced down over time by competition with passive, right? On contrast, the world's largest passive vehicle is actually the Vanguard Total Market Index. Across its various classes, it's about $1.6 trillion in total assets. It's carrying $84 million worth of cash, right? I just want listeners to actually pause for a second and imagine how you would react to a hedge fund that shows up in your offices and says, you say, what's the AUM? And you say it's 1.6 trillion. And then you say, well, how much cash are you carrying? Like, oh yeah, we've got $84 million in cash. You would throw them out of your office for being totally irresponsible. And yet this is how we direct all of the investment in our country now. The next chart is showing the volatility on fundamental events. You're actually seeing this dramatic increase in volatility around fundamental events. Again, that makes perfect sense in the context of what I've just shown you, which is this rising concentration and effectively low floatification of the market as more and more assets are held in the hands of totally price insensitive and, even more importantly, informationally insensitive investors.
Right. And essentially what this is you can tell this because earnings announcements have a much larger impact.
Correct. Right. And so all of the data that we use as academics actually can fly in the face of this, right? Because perversely, how do we define efficiency in markets? Quickly, and what fraction of the information is in response to fundamental events. So perversely, in an environment in which all the crazy behavior that is non-market related happens on the day of earnings announcements, that feels very informationally efficient, even as it's logically insane.
Yes, right. Yeah.
Right. So like when people talk about efficiency, it's really important for them to understand that the academic definition of efficiency and the man on the street definition of efficiency can be completely at odds. Right. The next thing that happens is the question of individual corporate elasticity. So how, we've talked about elasticity within the market and how that's changing with the increase in correlation, but even more important is actually the underpinnings of the elasticity of any one stock, right? So this is the work of Valentin Haddad at UCLA. Again, a 2021, 2022 rewrite paper. And the chart that I'm showing you here on the screen is a chart showing market capitalization versus elasticity, right? And remember, elasticity higher perversely means that a change in supply and demand has less of an impact in price. A more inelastic stock has a much larger change in price for a change in supply and demand, right? Surprisingly, at least for those who are thinking about this from the traditional fundamental framework, the larger the stock, the less elastic it becomes, right? And so what this actually means is perversely the stocks that are most affected by this passive dynamic are actually the largest companies. And you can just easily think about this from a theoretical framework, right? You're an active manager, Rob. Apple is trading at 7 million times earnings. Are you going to buy it? No, right? You're like, this is the most ridiculous thing I've ever seen, or 7 million times sales. Let's just be, really absurd, right? You're gonna look at that and say, I'm not gonna buy it. But it's 7 million times sales. Apple is by far the largest component of any index that exists out there, and passive investors have to allocate to it. Correct. It exhibits itself as extraordinary price elasticity as well, because once you get to that point that all the discretionary managers are like, there's no way I'm touching that thing. The only people that the passive players can buy from are ironically other passive players, or you have to get the price to the point, and I think we're actually starting to see evidence of this. You get the price to the point that the management teams themselves say, well, if nobody else is going to sell you shares of my stock, I'm going to
Right.
sell you shares of my stock.
Right. Okay.
Right. And so the thoughtful operators in this space, and by thoughtful, I kind of mean crooked. There we go. Guys like Michael Saylor at MicroStrategy, or
Okay, let's name names.
let's name names, right? But you actually are seeing this, right? Carvana, the nonsense guys that are over there, they're issuing AMC, right? They issue shares when you get these extraordinary price movements. The passive players mechanically have to buy into that issuance in order to maintain their market capitalization. It's supportive of the stock, even as it's locally intrusive on the stock, right? It causes the price to fall down, but they don't care because it's so far deviated from fundamental value that that injection of cash de-risks it for the management team. So like we know how this plays out, and Jim Chanos actually just, he and I just had an interaction on Twitter where he's like, Mike, it's going to end the same way it always does. The fraudsters are going to sell their shares, right? And that's what we're watching, right? We see the insiders selling explode, even as people are telling us there's no hard landing, soft landing. It's, to the moon, Alice, basically. Again, Haddad's work can almost be thought of in the context of, and so I show a quote here, right? The large increase in passive investing over the last 20 years has led to substantially more inelastic aggregate demand curves for individual stocks. Demand is more inelastic. Small changes in market structure can have a large effect on prices because investors are unwilling to change their positions. It's almost like a statement of principle for Vanguard.
Right. And actually, so I was unfamiliar with this paper until I read your piece. So we're going to
Yep.
put this in the show notes because this is
Fantastic.
a fairly recent paper that I think maybe a lot of people haven't read.
Well, and again, like I would strongly encourage people to do that, right? I'm a huge proponent of the CFA education process, but the CFA itself is still, the program is built around the insights from the 1940s to the 1980s. All of this information is nowhere to be found in the curriculum, right? And it candidly is being resisted for inclusion in the curriculum by players like Vanguard and others. And you're naive if you think that they don't actually know some of this stuff, right? So like, let's suspend this, right? We're all financial analysts. We're not naive. You have to understand that the systems that are in place are discouraging the dissemination of this information. So congratulations for tuning in and becoming educated. Again, back to the, what should we expect to happen? The passive model allocates more money to the largest stocks. That perversely means the next dollar into Vanguard is going to buy more of NVIDIA than it did before the price of NVIDIA went up. The exact opposite of the behavior of the discretionary active manager who would respond to that increase in price against their discounted cash flow analysis and say, in the absence of fundamental information, a higher price lowers my future return, therefore I'm more willing to sell it. Perversely, passive does the exact opposite, right? It says the price is higher, that must represent information content. Like that's the theory behind it, right? But actually in practice, they don't care. There is no consideration of the fundamental information.
Right. Now, this is actually one of the questions I have for you. So, because I wasn't quite sure I understood this, but as the price of the stock rises and the number of dollars, the same number of dollars that comes in, shouldn't that buy less of that stock and therefore quell this a little bit?
It does buy less of the individual stock,
Right.
but more of the dollars that come in are put to that individual stock.
Oh, I see. So it's not the number of dollars in the individual stock, it's the overall dollars into that one stock that matters.
relative to all the other stocks, right?
Yes, of course. Yeah.
So if you think about a small cap issue, right? And this is again goes back to the Valentin Haddad work, right?
Mhm.
Like I can build, there's two ways I can replicate the S&P 500. I can build it using buying every single stock, or I can statistically sample and buy the minimum number of stocks that allows me to replicate the S&P from a price behavior standpoint.
Right. Which, and there's a lot of research that shows that's somewhere between 19 and 35 stocks.
Exactly.
Yeah,
right?
yeah.
Now, in those 19 and 35 stocks, do I have to include Delta Airlines or Fox Media or Liberty, any of these small companies? No, because they're actually irrelevant to the performance of the S&P 500. Can I not buy Apple? Can I not buy Facebook? Can I not buy Nvidia? No, you actually have to. Even your statistical sampling is now forcing you to buy those names that you potentially ignore other names. By the way, we've got a very real world example of this in the small cap index, where Supermicro became by far the largest stock in the Russell 2000. Now, again, perversely think about how you as an active manager might react to that. That's a crazy valuation. I'm not paying that. I'm less likely to include it in my portfolio. In the statistically sampled version of the Russell 2000, it becomes more likely to become in my portfolio because I can't possibly exclude it at that weight. Right? So like everything that we're talking about creates demand for things that go up. It's almost like Bitcoin, right?
Almost. Yeah.
So the next chart that I'm showing is actually extending this into bonds. Ironically, most people think of passive in the context of equity markets. By far, the fastest growing area of passive is actually in fixed income. And there, you can't even support the logic for market cap weighting other than saying, hey, it's really easy to explain to people. And so perversely, if you actually look at who was buying all the negative yielding bonds, right, there was all this narrative around, it's asset liability matching from European insurers who need super long duration assets. That's right, exactly. That's not what was driving it. What was actually driving it is market cap weighted fixed income indices who look at a bond that's trading at 150 and say, boy, that's 50% more attractive than the same bond trading at par. Allocate more capital to it when it's at 150 than they do when it's at 100, right? That is totally indefensible in the framework of any form of discretionary investing. We know exactly one thing about a very high quality bond trading at 150. It's going to go to par.
Right, eventually.
So you're going to have capital losses in that, even as the money flowing into passive vehicles is buying more and more of it. I actually perversely think this is why the market exhibited such duration sensitivity in 2022. So I think we've seen a very real world example of this play out for us, right? Okay, and then the last component of that, those 5 dynamics that I hit on, and this is far from all of it, is this reduced ability for new companies to become public, right? And so if you actually look at the history of IPOs and the number of publicly traded companies, anyone who's listening to this podcast knows that both are falling, right? We're seeing fewer IPOs, we're seeing fewer publicly traded companies. And I was very comfortable with this, right? I actually pointed out like that slide has not changed since 2016, 2017, 2018, I think it was actually. But in 2020 and 2021, something crazy happened. SPACs, right? And we actually saw perversely a surge in the number of publicly traded companies as SPACs came to market. And we also saw, a surge in IPOs and everything else tied to this. They weren't really IPOs, but tied to this SPAC dynamic, right? And it turns out that this is the exception that actually proves the rule, right? So what was really happening with SPACs is if I went back and I looked at the methodology associated with index inclusion, and for listeners who aren't seeing this, I'm pulling up the methodology guide for the CRSP indices. This is what's used by the Vanguard Total Market Index from August of 2020. And I'm highlighting that in their methodology for index inclusion is special purpose acquisition companies are excluded from the indices. And you're like, well, wait a second, Mike, that's stupid. You just told me that they were a driver, right? How, if they're excluded, how does that matter? Well, actually, where it mattered was in how they then get included, right? And so the rules at that time were such that you were excluded as a SPAC as long as you were a cash instrument. But the minute you made an acquisition, an operating acquisition, you became eligible for consideration of index inclusion. And if you did a large enough SPAC, right, that you cleared the hurdle of basically the 85th percentile level of the small cap indices, you became eligible for what's called fast track IPO status. That the indices would have to buy a position in as few as 5 days. Well, the rules of SPACs are that insiders who hold all the shares can't sell for a minimum of 20 days. Guess what happens when Vanguard and BlackRock show up and try to buy shares that the insiders can't yet sell? Prices go totally vertical. They become large components of the indices. If you remember, the narrative that we used to explain the demand for SPACs at the time was that they allowed differential communications, right? That management teams could simply say things in SPAC roadshows that they couldn't say in the traditional S1 prospectus roadshow. If anyone is still listening to this, because most of the listeners will have tuned us out at this point, be like, oh, that's just another manager who claims, his problem is the market, right? But if for those of you who are still listening, right, remember that things like WeWork couldn't get public through the S1 prospectus process, but were ultimately able to get public through the SPAC process. And if you think for 1 second the issue is that Adam Neumann wasn't promotional enough during that initial roadshow, right? Then you have no business managing money.
Right, that's all he was.
Right, that's all he was, right? I mean, the most outrageous statements of all time, and a total failure to prosecute them when they should have been prosecuted. But the simple reality was that the opportunity to get companies public through SPACs existed for a window of time. Now, that means, by the way, that the largest buyers of things like Nikola, right, the famous electric truck being rolled down the hill, were actually the Vanguards, et cetera, of the world, right? They continue to be large holders. And by the way, they were buying well into the time period in which we knew that this was an outright fraud, right? So we know that that is not what actually happened. We know it's not that more promotional statements were able to be made, et cetera. Now, was 100% of the buying activity tied to Vanguard and BlackRock? Of course not. Nothing is 100%. I just want to emphasize, but part of what happened is you then created a narrative that sucked the retail crowd in and basically turned into a wealth destruction vehicle.
Yes, it did. It was, I mean, I remember when the first SPACs came out, all the professional investors were saying that the realistic opportunity for return after the IPO is about zero.
Right. And hugely negative, I think most of us would have argued, right?
Yeah, yeah.
But that's actually what causes bubbles, right? It's not so much people doing intentionally stupid things. It's people doing things that they think are broadly smart that turn out to be unintentionally stupid. Like assuming that all home prices in the United States can't fall at the same time, right? If you make that assumption and you behave associated with that, then you're going to lead to an expectation of low correlation of defaults that ends up breaking, right?
Right, which means your credit default swaps are fine.
Exactly, right, exactly. So anyone listening to this knows this story, but we forget that the same thing applies as it relates to all the other decision-making processes, right? So it's not so much that people are trying to, at least until very recently, and I think that's worth something hitting on at the very end of this, but when people are just putting money in their 401ks and not thinking about it, they're not thinking about the rules with which it's deployed. And so they look at the performance of the total market index over time, and they're like, oh, wow, that's pretty good. That sounds like it's something that'll really lead to me meeting my retirement objectives. As they're plowing money in, they're changing that history, right? They're changing the history and actually inflating valuations and lowering the future probability that we're going to hit those objectives. Next chart is showing just something that anyone listening to this can replicate. It's showing the skew of daily returns for the S&P, the NASDAQ, the Russell, and the VIX. The VIX is presented inverted. You can actually do this analysis yourself. What you'll discover is that the rolling skew is becoming increasingly negative, right? Again, this is completely consistent with money being plowed in. And
yeah, I think I saw something like this on Bloomberg. I think I saw something like this on Bloomberg a couple months ago, actually.
Right. And so you'll see charts like this, and they'll be presented in various ways, but almost nobody is going to tell you this is the natural byproduct of mechanically buying every stock in proportion to
Right, to passive behavior. Yeah.
right?
Yeah.
Okay, so now this is where it gets really interesting and relevant for the active manager community, because it actually plays all the way back down to things like modern portfolio theory, right? So when we talk about the returns to assets, one of the core assumptions in finance and modern portfolio theory is that asset returns can be modeled as somewhat normally distributed around an expected return. There's presumed to be an endogenous return to the asset class, that we can roughly estimate by looking at the history, right? So we take the S&P back to 1927 and we say the expected average annual return is X, and then we invest our retirement along those lines. But when you change the mechanism by which you invest, you actually begin to change that behavior. And so again, we're at a disadvantage because people can't see the graphics. But what I'm showing here is the traditional model, which shows the return of the portfolio against time. It's basically a sinusoidal wave centered around a central tendency.
Yeah. Yeah. And this is the basis of most asset allocation.
100%, right? And again, it's sensible and it's thoughtful. And it's nobody who's like saying, wow, I'm going to try and behave like Steve Martin and be a wild and crazy guy. Right. They're actually trying to do the exact opposite. They're, trying to be about as milquetoast as they possibly can, and just saying, I just want to be along for the ride. But being along for that ride is corrupting it. Now, where this gets really interesting is if you actually think about what alpha is, what it means in active management. Alpha is actually just the intercept in a simple linear equation. What's the return of my portfolio? Well, it's the beta times the market. That's the idiosyncratic feature we call alpha. I equals mx plus b, right? So if you use a linear solution to a surface that has become distorted or curved because of the impact of passive investing, gaining share over time, perversely, that curve now has to be solved with a linear equation. And if you solve a curved surface with a linear equation, your intercepts get manually forced down. And so this is what I'm showing on the chart is the actual equation and how this develops over time. It shows the alphas deteriorating exactly as we've seen has happened for active managers. The next slide that I'm showing here is the theoretical decay associated with active management alpha. And the next chart is the actual empirical data. And, Rob, you're looking at this, they're identical.
Yeah. Yeah. One's a little lumpier than the other one, but pretty much they're, yeah.
Yes.
Yeah.
Right. One is, let's be very clear, a model of 450 investors dumped in, right? So it's not going to be exactly the same, but it is actually telling you something really important. The narrative that exists in the space now is a variant of Grossman-Stiglitz. Passive will eventually gain enough share that it becomes really profitable to engage in active management. It actually turns out that the opposite is true. As you're in the process of passive share gain, passive is that 1,000-vote player in the wisdom of crowds. They run you over in the process. Right. And so what you actually are doing is you're creating a situation. I joke about this in the most gallows way. We've created the perfect active manager killing machine. And the only ones that survive are those who effectively begin mimicking the index, which is exactly the behavior we've seen in the industry, right? Long short is largely gone. Now it's, hedge funds are 85% correlated to the S&P or the Russell, right? And so we've engaged in this behavior because we're just trying to survive and play the game the next period, right?
Right. Because you can't, and when there's also the fiduciary obligation.
Right, 100%.
Also, which biases that, so.
Right. And I would also just like the analogy of the steamroller is an important one, right? Passive is the steamroller. You can absolutely take advantage of it over very brief periods of time. But when you're put into a position like this, the risk of error, the risk of ruin associated with a misstep just gets higher and higher and higher.
Right, and that is something that a lot of CFA study group members who have been in money managers for some time have understood.
Right.
That is, you can be right 3 times, and then the 4th time it costs you more than your 3 rights.
It costs you more than your 3 rights, and by the way, ends your ability to participate in the system. Right, and so from an evolutionary perspective, it makes perfect sense, particularly those who are the largest and most profitable in our industry are incentivized not to actually be contrarian. They're incentivized simply to play along with the game.
Okay, so let me shift this a little bit because this is excellent, and you've given us an awful lot to think about. And I'm going to put in the show notes, as I said earlier, several of the papers that you've referenced. But what I'd like to do to shift this now is from the data to the advice. And let me just play out a sort of intellectual situation here. So let's say you have a friend who's got a daughter named Joan. Joan's been out of school for 3 years. She's risen a little bit. She's got some decent amount of income, good income for a person of her age. she can put a decent amount of it in her 401k. Let's say she can max 401k, gets the max the 401k benefit. And she starts the job, gets the package from her HR company, and it says, which of these things do you want to do? And she comes and comes to you and says, hey, you're my dad's friend. You know what to do. What do I do?
The quick answer, unfortunately, is a variant of the Chuck Prince line, right? When the music's playing, you got to dance.
Right.
What I'm showing you is that as long as passive is gaining share, the right way to invest is to invest passively or even invest in a levered variant of passive, right?
Really? Right. Or
That
the only way
can.
you can exceed the
Right.
market is by doing that.
Right. And so when you have that curved surface, right, that constant march upwards, leverage enhances return. You become firms like, ones that might be named after biblical vessels of transport, you benefit from adding leverage to your exposure, right? So they basically ran at a 1.5 beta to the NASDAQ. That manifests itself as outperformance. And yet, when that misstep occurs, it turns catastrophic and you lose more money for investors than anyone has in history. Right. So, like, this is a direct byproduct of the evolutionary response that emerges in this type of framework. Yeah. And, like, if you just think about your CFA training, I don't know how else to say this, but like, you wasted your money because what you should be doing is the opposite of what you've been told, right? This is so, part of the reason we're talking is David Einhorn went on to a podcast with Barry Ritholtz. I'm going to be doing the same thing at some relatively soon. And David made the observation that markets are broken, that they are no longer focused on seeking out value. And that's really an important statement, right? I can't emphasize enough how powerful that interview was. And I encourage everyone listening to go listen to it and
Yeah,
listen to
I'll put
what
a link in
David.
there too. Yeah.
Please do. Because it is really, really powerful. David is not complaining. He's saying, like, it's simply true that markets no longer work to seek out value. What they're doing is what markets now do is they allocate retirement dollars. They're not trying to figure out the cost of capital. They're not trying to figure out where that money is best placed for an incremental basis. It's presumed that somebody else has already done all that work, but ironically, it's created the steamroller that then disincentivizes anybody else from doing the work because the risks are simply too high. Right now, David's solution was to say, I'm going to by and large become even more restrictive in my analysis and my work and focus only on companies that can return their capital to me endogenously without having to rely on the market factor, because I don't know when this is going to break, and I can't confidently invest under this greater fool theory. But unfortunately, Joan doesn't have David's skill set. She doesn't have his ability to dig into these individual companies. So ironically, the only thing I can say is like, look, if you want
Just
to
go with the greater fool theory.
you go with
Yeah.
the index fund until
Right.
this changes, and then it's going to be catastrophic. But you might be the last person to who's in and out right before it happens, right?
Yeah, or as an alternative, you might be young enough to survive.
Right, or you might be old enough. Actually,
Yeah.
the great irony is that your benefit is primarily received if you're old and you're selling into this what is very clearly a mania on my models,
Oh, I see.
right?
So if you're
And
selling the stocks to raise the cash for your lifestyle, then you're actually the winner.
you're the huge winner.
Yeah. Okay.
What have we actually done? We've created a system that maximizes the benefit of those who are at the front of this wave, allows them to exit into a Federal Reserve induced high interest rate environment where they convert to fixed income if they're thoughtful. The vast majority of them, by the way, are not being thoughtful. We are seeing some evidence of this, but very few people are taking advantage of this opportunity, in my analysis at least. And ironically, it means those that come behind are disadvantaged again, right? So, like, what we're doing is we're just setting up a massive generational conflict where we're bidding outrageous sums for the baby boomers' assets. And when the millennials' turn comes around, we're going to discover that there's no real bid for their assets.
Yeah, well, at their current income rates versus the interest rate, they're not going to have money for 401k anyway.
Yeah, unfortunately, I think that's right. But we are absolutely seeing this underlying dynamic. So unfortunately, my advice to Joan is the same that Chuck Prince would have given in 2006, right? When the music's playing, you got to dance. Unfortunately, we remember that because Chuck said it at exactly the wrong time, right? And there's a very high risk that those listening to this podcast will be like, "Oh, Mike Green told me to buy the S&P 500 at exactly the wrong time." Not the message, right? I'm actually telling you that what's happening is that the market is increasingly disassociated from the fundamentals and increasingly dominated by the simplistic flows. And at some point, that is ultimately going to reverse. And we're going to discover that we've made a terrible mistake.
Okay, Mike Green, this is excellent. Just super thought-provoking stuff. The people should hit you up on social if they can find
Easiest
you.
way to find me. I mean, my role is the chief strategist of Simplify Asset Management. You can find a lot of my work on the Simplify website. You can also, it's kind of easier to follow me than to avoid me at this point. So
Right. Yeah.
I'm at Prof Plum 99. And if you're interested in actually reading some more of the details behind this sort of stuff, I produce a Substack called yesigiveafig.com.
Awesome. Okay.
And you can go check that out for a lot of my writing in this area.
Okay, we're gonna put that in the your Substack in the show notes too. But wow, this is great. So
Glad you
the
enjoyed it, Rob. Thank you
yes,
for having me.
yeah, thank you for being here, and thank you to everyone listening and sticking with us. I know this was a little bit tricky as an audio podcast goes, but I also have great faith in you all that you have your Bloombergs in front of you. So until next time, this has been Compound Insights, and I will always be your host, Rob Rowan.